let's talk about dividend investing via ETFs. You may be interested in dividend investing because of the regular cash flow this strategy is supposed to provide even when markets are crashing. After all, you've likely seen countless YouTubers talk about passive income from dividend-paying stocks by now. But since we European investors now have so many distributing ETFs to choose from, you don't know where to start. I get that. I was in the same situation 8 years ago when I started investing. I loved the idea of investing in dividend-paying ETFs on an ongoing basis and to see my income from these investments grow over time. The dream was to one day be able to cover my cost of living just from this cash flow, having my ETFs generate over €1,000 each month. And while my own strategy has changed since then for a few different reasons I'll get to later, that doesn't mean you can't do very well with a focus on dividend-paying stocks. Not to mention the psychological benefit of seeing regular dividend payments on your brokerage account, which is why we'll be looking for the best dividend-paying ETFs in this video. But first, we need to discuss common mistakes European investors overlook. Mistake number one, and likely the main drawback of a dividend-focused strategy relying on distributing ETFs, is definitely taxes. That's because we as investors in most European countries need to pay taxes on dividends as soon as they hit our brokerage accounts. And the higher the yield, meaning the percentage that's paid out on a yearly basis, the more you end up paying in taxes over time. To make things worse, this means you'll likely be paying a substantial amount in taxes, even during years when markets are down and your investment as a whole is in the red. Meanwhile, accumulating ETFs don't have this problem in most European countries, with you usually being able to push your capital gains taxes into the future until you actually sell some shares and realize a profit. That's because they automatically reinvest dividends into more shares of the stocks they hold, gradually increasing the ETF's share price rather than distributing dividends in cash to you. There are of course differences depending on where you live, with Austria and Germany being two examples that are a bit more complicated, but that won't be the focus of this video. By the way, while accumulating ETFs are some of the most popular variants here in Europe, you may be surprised that there aren't any in the US. That's because they would need to be taxed the exact same way as if dividends had been paid out. That in itself could be a reason why cash flow generating strategies tend to be more popular in America, and it means most Europeans have a small advantage when it comes to compounding via the use of accumulating ETFs. Then again, many countries here don't have tax advantaged retirement accounts like in the US, but oh well, you can't have everything. Before we move on, you can find my favorite low-cost brokers for ETFs in Europe down below in the description, which is a great way to support me as I don't do sponsors. Okay, we've now established that an income-focused ETF investing strategy is likely less than optimal from a tax perspective. Now let's look at mistake number 2. Picking an ETF solely based on its dividend yield. When picking which ETF to invest in, don't just focus on dividend yield. Instead, try to find as much data as possible on its total return, meaning dividends and capital appreciation combined, over the long run to help you make the right decision. Choosing an ETF only based on dividend yield is like buying a rundown rental property in a bad neighborhood just because the monthly rent payments look high. Sure, you're getting cash every month right now, but if the property's value drops and you need to invest additional funds into repair work in a few years, your overall wealth is actually decreasing despite the rental income. Let's look at some high dividend yield ETFs on Just ETF to show you what I mean. Starting with the Global X Super Dividend, tracking a selective index of stocks with high dividend yields from around the world, paying out dividends every single month with a current dividend yield of over 10%. Wow, in theory, this means you only need €120,000 to generate €1,000 in dividends each month. Doesn't that sound incredible? Well, sadly, even including the high paid out dividends, it's down close to minus 15% since February 2022 compared to the Vanguard FTSE World as a benchmark, which is up almost 32% over the same period. To make things worse, you also lost a ridiculous amount to taxes because of the high payouts. At this point, it's basically a donation to the government. Now let's look at two highly popular options which are definitely better than this one. First, the iShares Stocks Global Select Dividend 100, tracking the 100 highest paying dividend stocks in the Stocks Global 1800 index. It pays out dividends on a quarterly basis and has a yield ranging between 4 to 5.9% per year. Its total performance, including paid out dividends, has been good. Well, at least until you compare it to the MSCI World that also covers stocks in developed markets, which basically performed twice as well since the end of 2010. And lastly, the most popular high dividend ETF in Europe, the Vanguard FTSE World High Dividend Yield, which tracks high dividend yielding stocks from all across the world, including including emerging markets. It currently has around twice the dividend yield compared to the normal market cap weighted FTSE Overall index and also pays them out quarterly. But when looking at its total performance including distributions, it sadly also far underperformed its default counterpart, the FTSE Overall, by 86 percentage points since 2013. Again, try to keep your investment's total performance in mind, both capital appreciation as well as paid out dividends combined. High dividends are nice, especially psychologically, but they shouldn't be your primary focus if you're trying to maximize your long-term returns. That being said, there are some dividend-focused ETFs that have been able to compete with global market cap weighted indices. We'll get to them right after. Mistake number 3, not being aware of what you're investing in. Pay attention not to get blinded by a high yield without understanding where your money is going and what your ETF is holding. A high yield isn't always a good thing. In fact, it can often be a red flag. Here's why. A stock's yield can go very high when its price drops significantly, often because the company's future looks uncertain or it's facing serious challenges. Since yield is calculated as dividends divided by the share price, if the price drops but the dividend stays the same, the yield shoots up. This can make a risky stock look attractive on paper, but its high payout may be a warning sign instead. Compared to market cap weighted ETFs, high yield ETFs also tend to be heavily concentrated in different sectors like financials, as you can see when comparing the FTSE Overall high dividend yield to its regular counterpart. That's because financial institutions like banks typically pay out a significant share of their profits as dividends, unlike technology companies, which is why their respective share in these ETFs is heavily reduced relative to what it should be based on their market cap. However, banks are often highly leveraged, meaning they carry a lot of debt. If there's another financial crisis or a sharp economic downturn, these ETFs could be hit particularly hard because of that sector concentration. So always look under the hood at what you're investing in, understand the risks, and don't just chase yields. Now that we've gone over some of the drawbacks, we also need to acknowledge the psychological benefit dividends provide. Receiving regular dividend payments can feel comforting, as it reminds you that your investments are still working for you, even during difficult periods in the market, of which there will be many when you're investing long term. This could be especially helpful if you're a new investor, as a steady cash flow can provide some sense of stability and peace of mind, helping you avoid impulse decisions like panic selling during downturns. But again, there's a trade-off here. The psychological comfort usually comes at the cost of tax efficiency and potentially lower total returns compared to market cap weighted accumulating ETFs. Ultimately, there is no one-size-fits-all answer here. It all depends on your personal preferences and goals. Finally, here are what I consider to be some of the best dividend ETFs right now based on my research. I added all of their names and ticker symbols in the description below. Since yield in isolation is not a good metric, as it could also mean low profitability and high leverage, I like dividend-focused ETFs that add an additional quality filter as well. For example, the Fidelity Global Quality Income ETF, which tracks high-quality companies from developed markets with a high dividend yield. The underlying index has been a strong performer, with a historical net return of 9.18% per year since 1997. In fact, it has been pretty much neck and neck overall with the MSCI World since 2014. One reason for that could be that its sector allocation is quite similar. It pays out dividends every 3 months, and its yield tends to hover between 2.5 to 3% per year, which may not sound like much by itself, until you see that the MSCI World's dividend yield was only 1.6 to 1.9% on average the past few years. So we're still talking about 50% more in dividends on average. And if you really value a high dividend yield, the VanEck Morningstar Developed Markets Dividend Leaders ETF, which tracks the performance of companies that display consistency and sustainability in dividend payment patterns, could be worth looking at. It has averaged an impressive 4.6 to 5.3% in dividends the past 4 years, and while it lagged quite a bit behind the MSCI World during a few periods since 2017, it has held up pretty well overall as of today, which probably explains why it has grown so much in popularity to over 2.5 billion euros in assets under management. Still, you should be aware that it's currently highly concentrated in the financial sector, with these stocks making up 43.5% of the ETF right now. That's nearly 3 times as much as in the MSCI World, just for comparison, so keep that in mind. Option number 3 will be simply going with a global market cap weighted ETF, like the distributing Vanguard FTSE Overall, with the added benefit that you're investing into thousands of stocks not only from developed but also emerging markets, and you're not missing out on many highly productive, innovative companies only because they're not paying out dividends right now. Here's the thing, big names like Amazon, Netflix, Spotify, Shopify, Berkshire, PayPal, and Tesla never pay dividends because they prefer to reinvest their profits back into growing their business. As a result, the Vanguard FTSE World understandably has a slightly lower yield, ranging between 1.8 to 2% over the past 4 years. As for its high dividend yield counterpart, its total performance, including reinvested dividends, is just too far behind to make this list in my opinion. Now, since you're likely a European investor like myself if you're watching this video, a simple fourth option could be adding a small allocation to the Vanguard FTSE Developed Europe with its higher dividend yield of 2.9 to 3.4% the past 4 years. That way you can also raise your exposure to Europe if you so wish, since European stocks currently only make up 15.3% of a global FTSE World ETF. If you like to focus your investment on dividend-paying companies as you like the regular income aspect when investing, you could consider an allocation like this: 70% Fidelity Global Quality Income and 30% VanEck Morningstar Developed Markets Dividend Leaders. By combining the two, you're able to get dividend payments 8 months of the year since they pay them out at different times, and an average yield of around 3.4% based on the past 4 years. Now here's my own investment approach and how my view shifted over the years. I like keeping my investment strategy as simple as possible and to invest into stocks globally, no matter if they pay out dividends or not. While my wife and I started our investing journey in 2017 with a focus on distributing ETFs, as we found the income aspect quite motivating at the time, we've been exclusively buying accumulating ETFs over the past 4.5 years, and here's why. Since we have no need to touch our investments until our early retirement, and even then we may be making a bit of money on the side, distributing ETFs will not only cost us more in taxes, but also in time and fees when reinvesting those dividends. Meanwhile, accumulating ETFs do this on their own, raising the share price by the amount that's reinvested on an ongoing basis. Now, the trading fees using the most reputable European brokers like my personal favorite Interactive Brokers are as low as €1.25 using tiered pricing. We can always sell shares of our accumulating ETFs if we need money in retirement, basically simulating our own dividend payment. I now view dividends distributing ETFs pay out to us investors as sort of a forced withdrawal we may have no need for at the time, but which we still need to fully pay taxes on as soon as it hits our account. Just to clarify, we've still held on to our existing distributing ETF shares as they're still in line with our long-term investment strategy, and selling them and having to fully tax unrealized profits would not make sense until we actually need the money. And honestly, we do get a bit of enjoyment from some dividends showing up in our account on a quarterly basis this way. So I fully understand anyone who likes this aspect and chooses a dividend-focused investing strategy as a result. Ultimately, it's fully up to you how you choose to invest. There is no right or wrong answer. You need to figure out what works best for you and what keeps you motivated, especially during difficult periods when markets are down. Now, I'd love to know in the comments, do you prefer a dividend-focused investing strategy or accumulating ETFs? You can find all the ETFs I mentioned in the description below, as well as links to my favorite low-cost brokers in Europe for ETFs, which is a great way to support me if you'd like to, as I don't do sponsors. Oh, and you should definitely check out my most recent video here next if you haven't seen it yet. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.